Assalamualaikum everyone. Today I will present about MFRS 134, which is Interim Financial Reporting. An interim period refers to a financial reporting period that is shorter than a full financial year, such as quarterly or half-year reporting. The purpose is to provide timely financial information before the annual report is prepared. Interim financial reporting can be presented in two forms, which are a complete set of financial statements or a condensed set of financial statements. MFRS 134 explains the minimum content that must be included in these reports. Besides that, this set standard also outlines the disclosure requirements and the recognition and measurement principles that companies need to follow. Overall, MFRS 134 helps ensure consistency, transparency, and comparability in financial reporting so that users like investors and creditors can make better decisions. For question 2, two significant events and transactions that can affect an entity's financial position and performance are changes in revenue or earnings and changes in financial position or liquidity. First, changes in revenue or earnings mean there is a major increase or decrease in sales or profit during the interim period. For example, sales may increase during festive season or decrease because of weak customer demand. This is important because it shows the company's ability to generate profit and cash flow. Second, changes in financial position or liquidity refer to situations like taking new loans, repaying debts, or having cash flow problems. These changes help investors and creditors understand whether the company is financially stable and able to pay its obligation. Both of these events are important because they give users a clearer picture of the company's current performance and financial condition before the annual report is prepared.
Thank you, Fariha. Next, I will present about the interim reporting period. Petronas interim reporting provide insight at regular interval throughout the year, comparing both current and previous period in compliance with MFRS 134 interim financial reporting. Interim reporting enables Petronas and its stakeholders to monitor financial performance and respond to changes in market condition or operational result. By comparing each reporting period with the corresponding period in the previous year, trends can be identified yearly, allowing for more informed and timely decision making. Using Petronas as an example of a major company in Malaysia, interim financial statements are present with both current and comparative period to assist user in evaluate performance trend. Next, we proceed to current and comparative interim financial statement. Starting statement of financial position for current from starting 1st January 2034 to 30 June 2034. Meanwhile, comparative from 1st January 2033 until 31st December 2023. Next, statement of profit or loss and comprehensive income for current starting 1st January 2024 until 30 June 2024 for interim. 1st January 2034 until 30 June 2024 for cumulative. Meanwhile, 1st January 2023 until 30 June 2023 for interim. 1st January 2023 until 30 June 2023 for cumulative. Next, statement or cash flow starting 1st January 2024 until 30 June 2024 for comparative. 1st January 2023 until 30 June 2023, and the last statement of changes in equity for current 1st January 2024 until 30 June 2024 for comparative 1st January 2023 until 30 June 2023. Alright. This is the statement of financial position for Petronas compared with the previous year end 31st December 2024. Overall, the report shows performance for the period and increase in the total assets, which could be due to the higher cash or investment activities. At the same time, liability also increased, possibly due to a higher borrowing or operational expenses. For statement of cash flow, show cash flow and outflow present on a year-to-date basis. Operating cash flow show an increase, meaning the company is generate more cash from operation, or sometimes a decrease, which might indicate higher payment or investment. For Sochi, statement of changes in equity show increase in retained earning if the company makes profit, or changes in equity due to dividends paid, also present on a year-to-date basis. These interim reporting periods are important because they ensure comparability between periods, provide up-to-date financial performance, help stakeholders make better decisions. In conclusion, the interim financial report of Petronas include the key statements such as SOP, SOPL, balance sheet, and the cash flow, each present with the current and comparative period. These follow the requirement of MFRS 134, ensuring financial information is relevant, reliable, and comparable.
According to MFRS 8, an operating segment is a part of an entity that conducts business activities from which it can earn revenues and incur expenses. Under MFRS 8, the CODM is not necessarily a single person with a specific title. Instead, it refers to a function, the role of allocating resources. Let's look at Petronas Chemicals Group Berhad. In PCG's annual reports, the Managing Director and CEO act as the CODM. They review segment performance and make. Now, consider Axiata Group Berhad. Here, the Group Executive Committee is identified as the CODM. This committee collectively reviews financial and operational performance.
There is two types of the segmental report, which is business segment and geographical segment. In the business segment refers to a part of the company that focus on specific product, services, or a group of related product. Each segment has its own risks and returns, which may be different from the other parts of the business. For example, a company may have one segment of electronic and another for clothing. Next, we move to the geographical segment. This type of segment is based on the different location or regions where the company operates. Each geographical area has its own economic environment, which means the risk and return can also be different. For example, a company operating in Malaysia and Japan may face different market conditions. In conclusion, segmental report helps users understand how different parts of a business perform, whereby product or by location. For the business segment, as we can see, Petronas divide its operation into different business activities such as upstream, downstream, and gas operation. Each segment shows its own financial performance, including revenue and profit. This helps us to understand which part of the business that contribute the most of the company overall performance. Okay, we move to the next, which is geographical segment. Petronas also report its performance based on different regions, such as Malaysia and international markets. This allows us to see how the company performs in different economic environments. For example, operation outside Malaysia may generate different level of the revenue due to the market demand and global oil price. In conclusion, this example shows how segmental reports help stakeholders to analyze performance more clearly with both type of the business and by the location. One of the main benefits is transparency in segment performance. Segmental reporting clearly shows how each part of the business contributes to the overall result of the company. This makes it easier for the user to understand which segment is performing well and which are not. In addition, investors can identify profitable and loss-making segments. This helps them to make better decisions and improve their ability to assess risks. For example, they can focus more on strong segments and be cautious of the weaker ones. In conclusion, segmental reporting provides clear information, improve decision making, and help stakeholders better to evaluate a company's performance. Segmental reporting is essential because it shows exactly how our revenue is spread across different countries and regions. It's not just about the total number, it's about where the money coming from. This helps users and investors to understand our exposure to various economic environments. By looking at this segment, we can see how the company is diversified. If the one region face an economic downturn, we can evaluate how other regions help balance the risk. In short, this transparency gives us a clearer picture about the company's global footprint and its resilience in the market.